Today, we're going to be looking at discounted rate mortgages. What are they and are they cheaper? Hello, welcome back to our channel and podcast. My name's Gemma and here at WIS we talk about all things relating to money, mortgages and positive money mindset. So if that interests you, then be sure to subscribe to our channel and hit the thumbs up. It really helps with our YouTube algorithm and means that you won't miss out on any of our videos. On today's episode of Let's Talk Money and Mortgages, we have Ifti joining us. And for those of you who don't know Ifti is a trained accountant and mortgage advisor who has been in the industry for over 11 years. He is also one of the founding directors here at WIS. Welcome back, Ifti. How are you today?
Hi, I'm very well, thank you. How are you, Gemma?
I am good, thank you. So today we are back and we are talking about discount rate mortgages. Let's just start with, what is a discount rate mortgage?
Yeah, I think that's a good question. Yeah, it's a very popular question these days because there are a lot of discounted mortgages which come up in your sourcing, we call, even if you compare price comparison website, there are a lot of discount mortgages that's coming up these days. So there's a lot of questions from our clients on this. So a discount mortgage, in essence, banks have something called a standard variable rate, right? A standard variable rate is a rate at which the banks lend out to clients if they don't have a mortgage deal, right? If you get a 2-year deal or a 5-year deal, if you're outside the deal, you have something called a standard variable rate. So a discounted mortgage is a discount on that standard variable rate. So I'll just use a simple example. If the bank's standard variable rate is 5% and they say they give a 3% discount, the discounted mortgage rate is 2%, right? So that's what it is. So it's a discount on the bank's standard variable rate. So that's called a discounted mortgage. So it is a tracker product in essence, because if the standard variable rate changes for the bank, it does change for the client as well, right? So it could go up and down. It all depends on what the banks decide to do.
Now, you just mentioned the word tracker, but some people might not even know what that is. So what is a tracker and how does it vary? How does this discount rate vary from a tracker product?
Okay, so both these products, trackers and discounts, are variable products. Variable meaning, like if you take a 2-year deal, in that 2 years, the rates can vary. It can go up and down. Right? Yes, it could do, right? So trackers are the more popular ones. These are the ones that people are used to, familiar with. Tracker is connected to the Bank of England base rate, right? So as of today, the Bank of England base rate is 1%. So if the Bank of England decides to increase the 1% interest rate to 1.5%, the interest rate you pay will go by 0.5%, will go up, right? Because it's gone up by 0.5%. So it will affect you. So that's the tracker, right? But then the difference with the standard variable rate, or, in this case, the discounted rate, it's nothing to do with the Bank of England base rate, but it's to do with the bank's lending rate, right? So if the bank's standard variable rate changes, it changes, right? So that's the big difference between the tracker and the discounted. In essence, both are variable rates, but obviously the way it's made up is slightly different.
Getting your mortgage online doesn't have to be complicated. At WIS, our website will help guide you through step by step. Our fully qualified advisors can help you get the most suitable mortgage for you. Then you can relax, safe in the knowledge that WIS are working in the background to get your mortgage approved. WIS. Online mortgages made simple.
Okay, so now we know with SVR rates, usually they don't have early repayment charges, but is that the same then for a discounted mortgage?
Okay, so that's something you have to be very careful about. So if you're on a standard variable rate, there's no early repayment charge, which means you can come out of the mortgage without paying a penalty.
Yes.
Now, if you're on a tracker, most trackers, not all trackers, they are also like a SVR because in many ways it's very similar, but the difference is, like obviously you're on a deal, right?
Yeah.
So those don't have early repayment charges well with most lenders. I have seen certain lenders who have tracker products with early repayment charge, but quite a lot of lenders don't, right? Now on a discount, there is a difference. Most of the time, at least the ones I've seen very recently, they do have an early repayment charge. So you might get the mortgage at a discounted rate. I mean, I looked at rates the other day for somebody. The fixed rate they were getting was about 2.5%. The discounted rate was about 1.5%. So there's a massive difference. Obviously, on a big mortgage, it does make a difference, right? But these have early repayment charges. So in case your rates go up and you say, okay, I want to come out of this mortgage because it's going to cost me now, you will have to pay this penalty and come out, right? So in that sense, it's very similar to a fixed product. product, because I haven't seen fixed products without early repayment charges, right? So in that sense, it's very similar to that. So there will be early repayment charge.
And you kind of mentioned it, but at the moment, would you say discounted mortgages seem to be cheaper, those rates?
Yeah, I mean, the rates on the face of it, it looks cheaper, right? Obviously, it depends case by case and what you're trying to do, what your circumstances are. You have to take those into account before making that decision. But I can see people being open to the idea of discounted rates now, right? It's getting more popular, right? In the past, people never ever thought about it. All what they thought about is a fixed rate mortgage, right? That's kind of it, right? Because in the past, people were very happy doing that. But now, because there is this parity, right? There's a difference, like I said in the previous example of about 1% difference, people are looking at it, right? So if, for example, there's a 1% difference, 500,000 loan, the interest for a year is £5,000, right? So if it's a 2-year deal, £10,000 difference, right?
Yeah.
So now people have actually started thinking about it. There is a risk, like I said earlier, if you take a discounted rate and if the rates go up, then you could be worse off. But if there's a difference of 1%, obviously the interest rate has to go up to 1% before the fixed product starts to be a bit cheaper. Obviously, a 1% rise is a big jump, right?
Yeah.
So that's why more people are still okay to take that chance, right? It really depends on the person, right?
What are the other drawbacks, if you were going to take this product? What would you suggest people think about before doing so?
Yeah, so you got to consider your circumstances, right? It doesn't fit all. Some of the tracker products out there aren't too bad either. Some of the products I see is between a discounted rate and a fixed rate, right? So if you are willing to take a chance, sometimes tracker ones might be okay because you can come out without paying the early repayment charge, right?
Yeah.
So that is an advantage you have. But the bigger problem is the discount is not based on what the Bank of England rate is. It is based on what the bank's rate is, right?
Yes.
So banks can just, make changes to their standard variable rates overnight, right? So they can. Usually it happens at the end of a month and they want clients as well, but that can. So you don't have much control, right? Because with Bank of England based rates, sometimes, you can see where the market is going. If it's going to change next month, you generally have a very good indication that it's going to change, right?
You see it in the news,
so
don't you? Whether they're going to have a monetary policy.
Yeah,
meeting.
you do. Yeah, that's right. So with banks, you really can't control because Bank of England, they look at various factors and, they take everybody into account. I'm not saying the banks don't do that, but, you have a little less more control over that. So that is a problem you find with some of the discounted rates. But also the bigger thing here is it's your appetite towards risk, right? So for some people are happy to sort of fix their rates saying, look, I don't care if it goes up. Even if it goes down, I'm happy to take a shot. But the thing is, I want to know how much I pay at the end of the month, right? So that's kind of the attitude that some people have because they don't want to take any risk, right? That's it. But for some people, they're happy to take a risk, right? Because they say, okay, we'll take a risk. If it goes up, fine, we lose, right? But, for that kind of person, this product may be okay because they're happy to take that chance, right? Again, it depends on the loan value as well, right? If it's a massive loan, do you really want to take a chance? You don't know, right? So it really depends on the person's attitude towards that risk as well. So that's why I say, it's always good to do assessment beforehand to see which one will probably suit you. Like I said, there are drawbacks for sure, but people are still looking at, discounted rates positively these days, right? So, yeah.
Now, I know you mentioned that the banks can change their SVR rates at any time. Is there any sort of restrictions on how much each time they can change it? Like, say, can they do something, like 2% all of a sudden increase if they felt like it? Or is it restricted?
As far as I'm aware, there's no restriction.
Okay.
But, banks will be mindful on how they do it. Because if suddenly a bank says, I'm going to increase the interest rate by 2%, they will be very, very unpopular. Right? It will come in the news, right? So I'm sure banks won't make drastic decisions like that. I know the discounted rate and the Bank of England base rate, they are really not connected. But usually what I find is when Bank of England changes rates, effectively standard variable rates changes and your rate changes, right?
There seems to be a slight correlation, right?
Yeah, there is, right? But in theory, there isn't a correlation. And if you ask the banks, they say that as well. But, most of the time that drives it as well, right? So, yeah.
All right. So this is the big question. Is it worth taking a discounted rate, would you say?
Yeah, I mean, I think that's what I was trying to said before, right? Yes, for some people it may be okay, because if the loan size is small and you're happy to take that risk where, if the interest rate goes up, you can pocket it, right? So for people like that, it's probably worth looking at that option. But like I said, if there's a 1% interest difference, the Bank of England interest rates or the market interest rates go up by 1% in the next 2 years, right? So that's something we don't know, because if you look at it a year ago, it has been, at 1% levels, right?
Yeah.
Some argue, it's gone up too much, it has to come down a little bit because they're talking about recessions looming. But whereas some say interest rates will go up, right? So we really don't know where it's going. It's one of those crystal ball sort of questions, right? You don't know the answer.
Yeah.
But for some people who are happy to take that chance, just in case interest rates go up, they're happy to sort of pocket it out as well. I think for people like that, it works, right?
Yeah.
But like I said, with questions like this, it's always sort of best to speak to an advisor.
Yeah.
Because sometimes you yourself is not sure, right? Because you just want to make sure that you're doing the right thing. You might need some advice before you make that final decision, right? Maths you can do for discounted rates, but it'll be based on today's rates, right? So you really don't know what the rate is going to be in a year's time. So with that kind of scenario, it's always difficult to work out maths, but advisors might be able to give you pointers on this one. So yeah.
Yeah, it's like all mortgages. They have their pros and cons, and it ultimately comes down to what's right for you, doesn't it?
Yeah, that's right. Yeah.
All right. Well, thank you, Ifti. Do you have any more points to add on discounted rates for us today?
Yeah, I mean, like I said, rates seem to be good. That seems to be a route that some people are taking at the minute as well. So it's always best to speak to an advisor on this one. And like I said, some of these products aren't offered by the mainstream banks, right? Obviously, the bigger banks, high street banks, they don't generally offer this product, right? It's generally offered by smaller building societies or banks, right? So they are the ones who are popular in this space, right? So if you walk to your traditional bank or any high street bank, you might not get this product at all, right? So with these kind of things, it's always best to speak to an advisor, or look at price comparison sites and then speak to an advisor, because they might be able to guide you, right? And of course, with some of the building societies, you have to be very careful on how they work, right? Because remember, building societies are not banks. They are governed by various other rules as well, because obviously the building societies work for their members, right? So there are certain member rules that you have to comply with. So those nitty-gritty stuff you may not know, right? But whereas advisors, you work with these people, you generally know these things. So they might be able to guide you better on this one.
Yes, thank you, Ifti. As Ifti said, please do check with an advisor to make sure these points are applicable for you. And if you don't have an advisor, I will leave our WS contact details below, as we are always more than happy to help. As we said before, a mortgage is secured against your home or property, so it may be repossessed if you do not keep up with the mortgage repayments. Thank you for joining us again today. We'll be back next week with another episode of Let's Talk Money and Mortgages. Have a great day, stay safe, and we'll see you again soon.